Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, the man, the legend, the governor of the great state of Texas, Mr. Michael Becker. How are you?
Hey, Paul, doing pretty good. We're now into May.
So the calendar is flipped over from April to May. And have you collected all your money on rents already, Mike?
Yeah, so April we finished out at about 2.5% delinquent. So a normal month, about 97.5% collected. So normal month is about somewhere between 0.5% and 0.75%, so 50 to 75 bips in delinquency. So four times maybe kind of a normal month. But all things considered, that's a big win relative to where we thought we'd be. Is what I feel like I'm repeating myself, but we were very pleasantly surprised, and so we're cautiously optimistic that May, I don't think will be quite as good as April, but hopefully it'll hang in there pretty well now, especially with the state starting to open up right about now, and hopefully kind of get the first part of normality coming back to life here in Texas.
So there's a couple different ways we take a look at occupancy. One's physical occupancy, the other one is economic occupancy. So I'm just trying to figure out your numbers exactly. When you say you were at 97.5 or so, can you walk me through kind of that formula of how you got there?
Yeah, so we're collected, almost 98% of scheduled rent. So we had, say, 2.5% of economic loss. On top of that, we have, physical loss. So I think portfolio average is about 93. So that puts you right around kind of factoring the physical vacancy out of the collections. We should be about 91 economic, kind of plus minus. So, with our physical loss and collection loss, we're 91% of kind of if every unit was fully occupied, or the market rent if every unit was fully occupied, we got about 91% of that in the door, which all things considered is pretty darn good.
That is good. So that's I'm happy for you guys. And now you got to work your tail off to get May's, to try to start all over again. I mean, that's kind of the benefit of rental income, is that you got to start all over again once you hit the end of the month. It's time to collect the rent one more time. So good for you guys. And how are you seeing? Is there transactions out there, Michael, or is there equity out there? Can you tell me a little bit about what you're doing these days?
I'm sure on both those. So I don't really see a whole lot of volume. There's a couple zombie deals out there still trying to get done from kind of pre-COVID. Most people that were pretty well stabilized and don't really have any stress of the situation. I think that the playbook, which is certainly we're deploying, is let's just kind of take everything off the market. Let's kind of hunker down and let's wait for this to kind of get on the back end of this, and then we'll reevaluate when the appropriate time to bring these deals back out. So that's the vast majority of people right now, because everyone collected better than we thought. I think there are a handful of deals that had some distress going into this fall that, this is just kind of putting them over the edge. So they already were, maybe in the low 80s on a physical and had some collection loss and stuff. And now they're going to get further stressed at their asset level. So those are some deals. And I've seen one or two where they're still trying to get some of their equity out. So we'll see how successful that is. I think those deals have probably got to clear at or below debt balance at some point to get those deals to actually go. And I just think it's going to take a little bit more time for the current ownership group to come to that realization, because they're going to keep trying, keep hanging on, and then the lender's going to give them some forbearance. So it'll be several months before we start seeing stuff like that clear, and then we'll start coming back in a little more transactions. Hopefully, probably a trickle starting in the fourth quarter, and probably into 2021, we start seeing volume pick up quite a bit. That's my personal prediction, at least.
Well, that is probably a good ramp to where we're going to talk to our guest today in the podcast, because we kind of want to figure out where the smart money is being invested in right now. Is it being invested? Is it on the sidelines? Where's it going to? What product types? And so in the podcast today, we have a guest that's been on our show before, but we put a lot of value into what he says because he's a pretty sharp guy. So welcome to the podcast, Hunter Thompson. Hunter, how are you?
Hey, thanks a lot for having me on, guys. Doing well.
We appreciate the time. And Hunter, I probably want to ask this question because Hunter finds ways to passively invest. Would you call yourself kind of a family office kind of guy, Hunter? Tell me a little bit more about what you do.
Yeah, that's a good question. I actually like the way of kind of phrasing that because in practice, yes, but not in terms of infrastructure. So when I started getting introduced to the world of financial markets, I was very turned on to the stock market, like most people are, just because of the marketing and the liquidity and such, and had a very big wake up call in the wake of not the 2008 crisis, which I thought was a great green light in terms of the opportunity to purchase value investments, but 2010. And I've talked about this publicly before, but 2010 was something that almost no one talks about. But for me, it was the most pronounced example of why only allocating capital to the stock market is a fool's errand. It was really in the wake of the European debt crisis that I found myself feeling like I was so correlated to something as obscure as something like the Greece bond yields that I just had no control over my investment vehicles. I mean, I couldn't mitigate that risk. I couldn't control that risk. I couldn't predict that the yield of the 10-year bonds in Greece were going to play a role in my entire portfolio. So that question of how can you get non-correlated assets to provide predictable outcome very quickly led me to real estate. And regarding your question about the family office, so, my first goal was to get my own money out of the stock market. My next goal is to help my immediate family members get money out of the stock market. And so it was a goal of divesting out of volatile assets that did not provide legitimate cash flow that could be relied on and into, again, recession-resistant, non-correlated assets, particularly the mobile home park business and the self-storage business, especially back then. And in the process of doing that, I realized that viewing your portfolio as a family office type of model can help people achieve what most people refer to as financial freedom far earlier than I think what is taught to us in schools, especially if you're following the typical model of, investing through a financial advisor, which will probably invest in mutual funds. So I think it's a good place to start the conversation because I think the passive approach to investing, particularly focused on the world of syndications, is a very direct line to what most people refer to as their ultimate financial goal.
So when you kind of realized that your current investment was not very resilient, right, and you didn't have any kind of control over it, you started investing in real estate. So maybe kind of talk about maybe some of your past. So you've been doing this for about a decade, I guess now, investing in commercial real estate of a variety of asset classes. So maybe kind of walk through some of your experiences and kind of where you sit today, what you've done this past, I guess now we're calling it this past cycle. What all did you invest in?
Yeah, so early on, I felt like I was very much willing to give up the upside associated with very cyclical asset classes in exchange for the downside protection. And part of that was due to the fact that my career was born in the wake of the Great Recession. I think that a lot of people that look at people that have only participated in this most recent surge in pricing, you need to pay attention to the years at which they were participating because, I know what it's like to go to networking events where everyone's head is in their hands. I know what it's like to go to networking events where every single month less and less people come because they just can't take it anymore or have lost their shirt. So my investment thesis was forged out of those times. And so in that process, I realized if I'm willing to give up some of the price appreciation associated with things like hotels, for example, which are obviously getting crushed right now, we are in the midst of a very unique crisis, but that is not unique in the sense that hotels tend to perform very cyclically, and it's very pronounced in terms of their volatility. I'm willing to exchange that to get very predictable outcomes. And I think the mobile home park business is something that most of your listener base is going to be very familiar with. It's a very clear way to create that recession resistance in the sense that no matter what happens, the worse the economy does, to a certain extent, the more demand there is for that product. Now, of course, that doesn't paint the whole picture. Just because there's demand for a product generally does not mean that your investment is going to be successful, but that does create a massive tailwind for the industry. You compound that with the fact that they're not building new mobile home parks and the fact that there's 10,000 people hitting the age of retirement, which is obviously in quotations because many of them don't have any savings whatsoever. And you have yourself a very favorable supply-demand disequilibrium that creates this great and very rare opportunity where you have stagnant or even decreasing supply and increasing demand. So that was kind of the first vehicle where I felt, okay, I'm very bullish on this. I'm very excited about the predictability of this, and therefore invested very significantly. A similar case can be made for self-storage, and a similar case, again, can be made for workforce housing, multifamily apartments. And so cumulatively, those three asset classes have been the majority of my portfolio over the last 10 years. But really the business model, which was started as me trying to invest my own capital, later, as I curated some really high caliber relationships in those various asset classes and a due diligence process, which is just far above and beyond what a typical passive investor could complete, even if they knew exactly what they were doing, because at a certain point, the economies of scale doesn't make sense. If you're investing only $100,000, which is a legitimate amount of money, you still can't spend 100 hours flying around the country looking at different deals. So I kind of felt there was an opportunity to build a business around the fact that we were doing that, for our own personal portfolios, and then to bring in additional investor capital to rely on our expertise as well as the Rolodex of relationships that we curated over the years. And that's really how ASIM Capital was formed.
So let me talk through a little bit here too, since you have a variety of asset classes. Like you mentioned, you've been in largely kind of the workforce housing, multifamily, market rate stuff. You've been in mobile homes, some senior living, and I think you have, you previously invested, but you certainly were, you mentioned before we started recording, looking into maybe taking a swing at some of the dislocation that's going to be certainly felt in the retail space. So maybe we kind of roll through what you currently have currently own and kind of how that's holding up here 6-8 weeks into the whatever we're going to call this COVID recession. Mobile home, let's talk about that. We don't talk too much about that on this podcast. As you mentioned, that's a market that has seen a supply contraction where the multifamily market rate has seen expansion of supply as we've been building several 100,000 units a year for many years now. It's the exact opposite in the mobile home space, but you're certainly serving to kind of the very, almost the lowest end, or at least my perception of it almost being the lowest end of the workforce housing market. So how has that fared here now that we got through a month of collections? What does that look like for you guys in April relative to historical norms?
Yeah, so from a big picture perspective, it's very early on, as of the recording, this being May 1st, the April numbers were we didn't really experience that type of contraction that you would have seen, especially in something like retail. I will say, though, that the majority of the tenant base in the mobile home park business consists of people who are making hourly wages, people who are unemployed and relying on fixed income, and a combination of both, or people that are unemployed, truly unemployed, not retired, but without a job. So obviously that tenant base is susceptible to this particular risk because the income that's being lost as a result of unemployment, which the numbers now, estimate somewhere between 30 and 50 unemployed people, regardless of the number of jobless claims, that's very, very concerning for this particular asset class. Now, of course, local, state, federal governments, they're well aware that the burden that this particular challenge is placing on these tenants, especially in the lower and middle incomes. And there's going to be action towards that. I think that the CARES Act that's coming out with the $1,200 check, for example, that is very meaningful to this particular tenant base. If we have a multifamily, or a mobile home park, I should say, lot that rents for $400 a month, that's 3 months of income when it comes to a $1,200 check. That's very significant. And it's very common for households to have 2 adults. So that could be, up to 6 months of rental income. So we'll see. I mean, the federal government's actions is really catered towards those who are struggling financially already. And those gross dollars tend to be very, proportionally meaningful when it comes to this particular tenant base. I think that the mobile home park business has taken a little bit of a beating in the public markets, the public REITs that are focused on mobile home parks. I think to a large degree that's unwarranted. I think that if the prices are still depressed as of the recording or the launch of this podcast, I think that's actually a great play if you are sitting on cash and are looking to participate, because a 30% decline in valuations in this asset class, I think, is going to prove a disequilibrium to what I think is market.
Can we go through some other asset classes that you guys have invested in and just kind of give me your opinion right now? So we talked about the mobile home parks. Let me know what else that you guys have invested in and kind of give me your brief on that.
Yeah, sure. Happy to do it. So let's start with one that's performing extremely well, which is the self-storage business. Now, in the public markets, again, I refer to those only to say that because the assets we have are private, they don't trade hands. So it's hard for us to anticipate that, those quote valuations, which is what's the benefits of investing privately, is you don't have to worry every day, wake up, look at your phone and see where your entire portfolio is. But the self-storage business has been relatively unaffected comparatively to the other asset classes, or at least impacted in terms of the public markets. And I think that makes a lot of sense. First of all, industrial is considered an essential business. Second of all, the tenants typically only come to the centers twice, once to drop off their things, once to pick their things up. So the risk about contagion, as far as on-site contagion, is something that's basically eliminated. And I'd say that you also have a lot of the big picture, quote, recession-resistant theses being proven correct to a large degree. So, for example, over the last 3 years in speaking engagements, I've constantly mentioned that kids moving home from college, especially unexpectedly, is a big piece of demand for the self-storage product. And it's very, very common during recessions. So now, this, of course, is a very unique situation where school has basically been canceled. But again, that's unexpectedly. And now we have kids moving home from college unexpectedly, and we're seeing a surge in income where we might have already seen that, 3 months later, but now we're seeing it in, April or early May. So that industry is held up quite well. There's a couple different data points you can talk about with that, but generally speaking, that one's performing quite well. I'd say one that is a very much interesting is the senior living business. Now, we recently did our first senior living deal with a very experienced operating partner several months ago. And now all of a sudden there's massive question marks in the senior living business. Well, first of all, they've taken a total beating in the public markets, down about 48%, which is very, very pronounced. That is interesting because a lot of the challenges associated with COVID have to do with the jobs market. That's not necessarily the risk when it comes to the senior living business. We're not seeing a challenge in terms of collections or NOI. The challenge is much more based on if a tenant gets sick, there's an issue with on-property contagion. So the tenants, for example, the way that rent is paid in senior living is through a combination of Social Security, savings from the tenant base, immediate family members, most of whom are making $100,000 or more and have jobs that can be done online or at home. So the NOI is not really impacted, but the issue is contagion. So we have to worry about not allowing coronavirus or any virus in the facility. And if it is identified in the facility, individuals need to be quarantined. And this industry is well prepared for this particular risk because it's constantly focused on that. Now, we have heard stories, horror stories, to put it lightly, in Washington in particular, where a 100-unit property, 16 units got sick, and I think 4 passed away. In the senior living space, that's really challenging. I mean, that's devastating, not only for the individuals that passed away, but the industry operates on a very high gross operating expense ratio. So with multifamily, for example, when you guys underwrite a deal, I'm sure that you're usually seeing somewhere in the range of a 45, 47% operating expense ratio. The senior living business operates on about a 70% operating expense ratio. So if you lose 5 tenants or 10 tenants, that's no good. You have to be very, very cautious about that. Again, the federal government knows that. I think that about $600 billion in grants and loans are now available specifically to the senior living sector. And I think that liquidity in combination with the PPP programs really going to benefit the sector in terms of providing a backstop. But again, unique risk, and it's a unique asset class that over the long term I'm extremely bullish on. But right now, in terms of transacting, it's a big question mark for obvious reasons.
Next property type, anything more like that? I mean, have you invested in class B and C multifamily?
Yeah, so multifamily, definitely you're feeling it in terms of collections. Those numbers that you guys were talking about previously, that's really outstanding, and kudos to you. It's just a testament to the way that you've been able to manage. If you purchased an asset, let's say in the last 6 months, especially if the previous manager was not doing a good job with collections, you can have some real serious challenges right now. So I'll just restate what I said, like looking at the other side of the same coin. If you purchased an asset where a big part of the thesis was, look, we have this tenant base who is not paying on time. The market rents are way under rent. The rents are way under market rates, I should say. And your thesis was, this is a massively mismanaged asset. Let's go in and turn it around quickly. That's very challenging to do, because if the tenant base is looking for an easy way out, that way out is here. Additionally, if you're contemplating turning over the tenant base to a large degree to bring in more quality tenants, there's a lot of bans against people even visiting properties now. So it can be a challenge. Now, of course, over the long term, again, I'm very bullish on the asset class, but I think that there's going to be a little bit of challenges on a quarter by quarter basis, as the unemployment numbers are just so staggering and a little bit frightening. And when you're looking at the workforce business, it's one of those businesses where we cater to a tenant base that is specifically designed for this particular product type, in the sense that there's not a lot of other options. So the pain is going to be there if there's going to be pain felt. So I know that's a short summary. I'm sure that a lot of your listeners are already familiar with that thesis, so don't feel like I need to go further with that. But if you have any questions, just let me know.
So that makes sense too, right? So we had the deals that have the highest level of delinquency within our portfolio, certainly are kind of the more recent assets we purchased, Hunter. So, some of those deals that we're kind of in the process of re-tenanting a little bit and maybe kind of curing some of the sins that the prior management company had made at the asset, both either physically and or just by improper screening and placement of residents. So that was, I think that's very true and relevant. So kind of moving forward, maybe one of the things we can quickly talk about too, you have a bunch of unique passive investors that have invested alongside you guys. What sort of communications have you guys been doing? What are you planning on doing kind of going forward as we get deeper into this? What does that kind of look like from you guys to your investors?
Yeah, I think it's an important time to communicate. Before we move on, do you mind if I just address retail real quickly?
Sure.
I think it's an important moment just because it's so considerably different than what businesses are prepared for. If you listen to any podcasts that I've been on over the last 3 years, I have been really excited about the opportunity in retail. We were hearing so much about the retail apocalypse, and as an investor, it's very wise and can be very lucrative to go right when everyone else is looking left. And so I didn't transact in the retail business, but was constantly reiterating there's going to be an opportunity, there's going to be an opportunity. And to be completely transparent, we were very close to purchasing a few assets. We just couldn't quite make the numbers work in a pre-COVID world. The reason I wanted to discuss this prior to moving on to investor communication is that was just an example of luck, to be completely honest. We wanted these deals to go through, and the numbers just didn't quite make sense. If we had moved forward with any of those deals, we would be having a very different conversation right now. And the reason for that is that a lot of businesses, when they look at things on a sensitivity analysis, even if they're not doing it in Excel, but they're just doing it from a gut perspective, they may anticipate a 25 to a 35% reduction in revenues, but it's very hard to anticipate a 100% collapse in in-store revenue. And so that's creating massive distress in the retail business. Now, we all understand that a lot of those businesses are not failing or struggling because the profit margins weren't there or because the business model didn't work. They're struggling because of, to a large degree, government mandates that people not attend their stores. So when there can be flexibility, there will be. And so we're seeing debt assistance, forbearance, and even forgiveness in that industry. But more than anything, we're seeing distress and massive question marks and uncertainty. And I think that the combination of those three creates a tremendous opportunity for pricing arbitrage. So while we were certainly frustrated working for several years trying to find a great deal in the retail center space, I think that there will certainly be an opportunity in that sector going forward. And sorry to jump back into the asset classes. I just felt like it's important to address that industry, which is, going through a really significant time.
Yeah, no, makes sense. Appreciate those comments. But maybe talk a little bit about some of the communication level you've been doing with your investors.
So it's interesting because to a large degree, if you are an operator right now, my guidance is you most likely can't over communicate at this time. And I know that this is something you guys have really been focusing on, doing more podcasts, being more in front of investors, doing more investor calls. There's a lot of reasons for that. The most important is that you don't want your investor base to be going to sleep at night thinking that any moment you're going to receive an email, which is bad news, which was bad news a month ago, that wasn't told to you until now. Bad news does not age well. So that's the first thing. The second thing is you want to put yourself in a position as a business owner to really stand out during this particular time. So if you have a bearish outlook right now, it's okay to be transparent about that. I think anyone that's listening to this knows that we're all going to make through this as a society. And as real estate investors, we're more prepared for this particular thing than almost anyone else. The reason I say that is every conversation that I've had with anyone that's been more than 10 minutes, at least half of it has been, when is the next recession going to be and how significant is it going to be? That's very common in investor language to use that kind of communication because it really matters to us. Most people are not contemplating recessions all the time. So it's a good time to be a leader for your investor base. Reach out to them. Something that we did last year, just in the middle of the year, we sent out more than 300 emails, individualized emails, requesting 15-minute calls just to check in, see if investors are interested in jumping on a 15-minute call. I'd like to share what we're looking at over the next 12 months and hear what they're interested in. That is a very simple strategy that on a risk-adjusted basis is very favorable, especially if you're not transacting in today's environment. So just a couple things. One other thing I'd say as far as investor communication, it might not be a bad idea if you're managing investors to write just a quick 5-part series on this particular situation. If you don't want to overdo it in terms of communication, just write upfront, say, we're going to do a quick 5-part series on the following topics: the economic implications, the asset management implications, what to expect in terms of communication, what to expect in terms of the debt terms we're currently looking at, and whether or not we're going to transact. I just came up with those on the top of my head. You guys can probably do a better job than that. But that's just one example. And then, okay, you've resolved it, turn it into an article, put it on your website. Anytime anyone asks a question about it, just refer them to that article. I feel like that's a really good way to spend your time as a real estate entrepreneur.
Good. So kind of moving forward, what's kind of your crystal ball tell you about when we start getting back and doing transactions? And then how do you kind of ultimately see this thing kind of resolving itself as far as the depths of the pain that you expect us to have before we start getting some proverbial green shoots, I guess?
So just like any potential risk in the economy, it all comes down to debt. The people who control the debt control the entire sector. So, what's the famous phrase? When is a economic expansion over? When the banks say no. That's it. That's when it stops. And so as long as you have liquidity in the market, you can transact. And as long as the banks, particularly the agencies, are well financed, which they are currently, there's going to be transaction volume that's going to eventually pick up. I think that the thing that people are concerned about is the completely ahistoric jobs numbers and seeing, 2008 jobless claims, which again just means I'm claiming for the first time that I'm unemployed. I'm claiming unemployed insurance. I need that for the first time. 2008 numbers in 700,000 peaked out. We've seen those numbers go from 700,000 now in 2022, 3.3 million, then to 6 million, then to 6 million, then another 3 million. I mean, it's completely, I've seen a lot of economic charts in my life. I've never seen one that looks quite like that. So that is giving people a lot of fright and scare. And there's a lot of mental side effects that go along with being unemployed, but they don't necessarily apply to this particular challenge because we're all on the same page. We know that if you lose your job, it's not because you didn't do a good job. It's not because the business plan wasn't profitable. It's because we have a massive pandemic and concerns around the pandemic, which were causing government shutdowns. So I think that fear is making people say, well, look at the jobless numbers in 2008 compared to 2020. This is going to be so much worse than 2008. That's not necessarily the case because of the liquidity. What happened in 2008 was that property renters were unable to pay rent. The owners were therefore unable to pay their loan, and the lenders were in such a liquidity crisis that they were forced to foreclose, even if it meant selling for pennies on the dollar. That flow upstream is not necessarily going to happen during this because of the liquidity that's in the space. Now, of course, that can change, and that's why I mentioned the date. We're currently in May 1st. I don't want to look like a fool if someone listens to this 9 months from now and the situation is totally different. But I currently don't anticipate that massive death spiral that we saw in 2008.
So I remember when I was in college, I took a psychology class, and they were talking about the people that fly onto aircraft carriers. You got a pilot and a co-pilot. The co-pilot typically did not have a stick when they were landing on the aircraft carrier, and that the pilot who was in control of the airplane, was able to guide the airplane down onto the deck, and the co-pilot who did not have a stick was extremely nervous every time the pilot were to land on the airplane, just because they were not in control of their own destiny. And so you are a super passive partner, which means that you're not an operator of the property, but you carry a big stick because you're the equity. And yeah, you think the loan makes the deal go around, but it's really the equity that makes the decisions about what's going on. So is there anything that's keeping you up at night, Mr. Co-Pilot, for possible capital calls or problems? I mean, you tell me what's keeping you up at night, Hunter, these days.
Yeah, I actually really like that analogy. And yes, it's totally true to a large degree, especially because I'm willing to give up control for diversification. That's one of the reasons I wanted to include that discussion about retail in this conversation, because the reason that we feel that we can intelligently participate in a variety of asset classes is that we identify and have curated best-in-class operators in their particular niches, which allows our investor base to be diversified. Now, if 100% of our business was in the retail sector, again, this conversation is not the way it's gone so far. Now, I know a lot of people that are retail operators, and they're going to be able to overcome this. It's just that they're going through a really, really stressful time, the likes of which our investor base isn't. So that would be a thing that would be really keeping me up. I think there's a lot of uncertainty in the distressed debt space as well. And we have not invested in that space as a company. I have invested personally in that space. The real risk with that, in my opinion, is when you go into a nationwide lockdown, the regulatory environment, which is always potentially a concern in distressed debt, is more pronounced. Are people going to be able to foreclose on people who haven't paid their debt? Not necessarily the case that anyone that invests in distressed debt, the business model relies on them actually foreclosing and taking the property, but just being able to foreclose or being able to evict in this environment is something that we've seen. There's been a lot of talk about that being banned, over a 3-month, 12-month period, either nationally or on a state-by-state basis. So the regulatory environment is always a question mark. I think that I'm probably not alone in being concerned about the big picture of the United States federal government balance sheet when I look at the money printing that's going on. I've had a lot of conversations with economists on this topic, and I know a lot of people agree and disagree with various claims. I'm not a big proponent of anticipating that just because money printing is happening, that means hyperinflation will happen. In fact, I'm very much a non-political, but philosophical libertarian. And when I see my fellow libertarians screaming that the dollar is going to die because of all this money printing, which I understand the philosophy, I hate it when people say the opposite of what's true, just from a big picture perspective. So you actually find when money printing takes place, usually the dollar increases in value. You actually see deflation, because the reason that money printing is taking place is because there's massive concern in the market. And on a macro level, people tend to speak out against the dollar until it really matters. So those are a couple of things that I'm keeping my eye on. Been very fortunate in terms of the asset classes we've invested in. So I have been able to sleep, but it's been, we've given up a lot of upside of some of the more cyclical asset classes in exchange for that. And now it's starting to pay dividends.
You may have mentioned this, but have you put together like an opportunity fund or a rescue capital fund? I know you just said, there may be governmental intervention on that, some of that stuff, but sometimes you can get a higher rate of return. And I think I've gotten, in this last week or so, I've gotten 10 calls from folks wanting to know if they could team up with us to offer opportunity funds out there. And I'm like, it's just not the right time yet. There's not enough blood in the bathtub, so to speak. Have you guys thought about putting together an opportunity or a rescue capital fund?
So not an opportunity fund. You mean like to take advantage of this current situation. Is that correct? Before I answer the question. Okay. Yep. Yeah. So, I'll put it this way. When we put a deal out to investors, we want three things. We want cash flow, current income. We want a clear vision into value creation, and we want a discount to market. It's very challenging right now to create price discovery in this environment. So if we're going to go out to investors and say we got an 8% discount, which just 9 months ago would be basically unheard of, we need to be able to verify that claim through comps in today's economic climate. So we're not going to be the first to market. We're willing to wait. And I think one of the benefits of real estate is that it moves much more like a barge than a speedboat. So you're not going to miss this opportunity to get these post-COVID deals. You don't have to be the first to market in order to take advantage of this from a pricing arbitrage standpoint. In 2010, trust me, everyone I know is saying this is an opportunity of a lifetime. And guess what? They were right. 3 years later, the deals I was getting at that time were actually better because I knew so much more about the industry. My net network had grown so significantly, and my level of sophistication had grown faster than the market had recovered post one of the most significant crises in the history of the United States. So that's kind of my guidance. There's no reason to move too quickly. You can always be patient with real estate.
I generally agree with that. I think my perception is I think we had 4 or 5 years before we really started to see pricing move dramatically, at least in the multifamily space in Texas, to be specific. I'm not quite sure we're going to have quite the same length of time, but I do think obviously there's no price discovery hasn't happened yet. So you're kind of catching the quote unquote falling knife if you try to move now, and there's very little opportunity anyways. It can take several months for that to kind of work its way through the first part of that to work its way through the system. But I do think what's definitely different today versus say 10, 12 years ago is that was certainly a financial institution and real estate led crisis where system wide the banking sector behaved very well this entire cycle and had pretty fundamental underwriting with some exceptions on the margins of it was starting to kind of show. So I don't think we're going to have quite as many as much there, but I think specifically maybe if you're talking about retail, that might be a lot longer to recover because this could be pretty deep. But I think in the multifamily space, I don't think we're going to have 4 or 5 years to kind of buy at or towards the bottom. I think it's probably going to recover. My guess would be by end of 2021 or beginning of 2022, we start getting back to somewhere near kind of pre-COVID pricing would be my expectation, just because we're not going to necessarily see consumer price inflation. I personally think with the amount of money they're printing and the keeping the interest rates as low forever, like Powell mentioned when the Fed met this week, I think that certainly will translate to higher asset prices down the road. So I don't know if you had any comments to that statement before we wrap up, Hunter.
Yeah, no, I actually agree. I think that timeline is totally reasonable. As opposed to being 4 or 5 years, it may be 4 or 5 quarters, but that is plenty of time to intelligently participate. That was kind of the point I was trying to drive home, is that you don't have to be the first to market. You don't have to be the guy that's trying to bounce things off the very bottom. And there likely will be some buyers that purchased assets that were distressed, or they didn't really know how distressed they were when they bought them, and now they're starting to figure it out. And my really my word of, it's really just a word of caution. And by the way, if you're listening to this and you're a real estate owner and you don't have anything that you're putting under contract and you're committed to not transacting for 60 days, let's say, I would send an email out to your investor base and let them know, as a company, we've made that commitment. And it doesn't matter what we see right now within reason, we're not going to be purchasing anything. As an investor, it's very good to see something like that. And it really puts investors at ease to know this is why the compensation is structured in the manner that it is, so that we can rely on them to make prudent choices in uncertain times.
So raising capital is the single most sought after and lucrative skill in the entire real estate sector. It's one skill that, if truly mastered, can ensure you'll always have a place in the world of investment real estate. Hunter, do you know where I got that from?
Yeah, that's right.
That comes right out of Hunter's book. So go on to Amazon and take a look at that. Hunter Thompson is with us. He's the founder and the principal of ASYM Capital, as in asymmetric capital, but just ASYM. He also is the host of the Cash Flow Connections Real Estate Podcast. You do want to have a chance, go on and put him into your iPhone and make sure that comes up every time that they do a show. So we do appreciate Hunter Thompson being on the call with us. Any last minute advice, Hunter, at all?
Yeah, well, first of all, I appreciate the shout out for the book. If you are on that side of the business, we actually gave away 1,000 copies for free at raisingcapitalforrealestate.com. That was like my goal of my life, is to give away 1,000 copies of that book. It happened in 3 months. So we decided to give away 5,000. So you can go over and get a free copy at raisingcapitalforrealestate.com.
Very nice. Very nice. So we appreciate Hunter being on the show. Michael Becker, thanks for hanging out with us. We do appreciate that. On behalf of Hunter Thompson, Paul Peebles here, and Michael Becker, have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.